Welcome to the Market Mosaic, where every week we are looking at macro data, stock market technicals, and internals, things like breadth and sentiment, to try to figure out where the stock market could be headed over the near and intermediate term. And we had a monumental week last week for data. We got a double dose of bad news for investors. It threw the interest rate outlook into question. It raised stagflation concerns. So let's just quickly break down what we were seeing last week. So first thing we had was a hotter than expected inflation report with a metric that's closely followed by the Federal Reserve, the Personal Consumption Expenditures Price Index. It's a mouthful to say, but this is the Fed's preferred inflation gauge. It rose by 2.6% in June. That's important because it's an acceleration from May's 2.4% pace. If you look at the core figure, so we're stripping out food and energy there, it increased by 2.8% and was higher than expected. Now, here's what it's important to note is that the Fed's target for PCE inflation is 2%. Whether you're talking about the headline or the core figure, both are running well ahead of the Fed's 2% inflation target. And something else you really need to pay attention to here is the rate of change. The rate of change is inflecting upwards. So that's what this chart on here is showing. It's showing for the core PCE what the annualized change looks like over the past 3 months, 6 months, and then the past 12 months as well. And again, it is the rate of change that's starting to pick up. So you can see, really even the 6-month annualized change bottomed out back at the start of 2024. And it's had some ups and downs, but you can see overall it's been moving higher over the last year and a half or so. And we're starting to see this black line of 12-month rate of change. It stalled out, and now it's starting to pick up a little bit. So if we continue to see this trend inflect higher, start to accelerate, that rate of change matters a lot for what the Fed's going to be watching. It's going to matter a lot for investors. This rate of change, if you look back at the last big inflationary wave in 2021, into 2022, this was a big catalyst for the Fed getting restrictive on policy. So we had 2022's bear market and stocks. Since then, the bull market we've had the last several years has mostly occurred with this disinflation trend. So inflation still positive, but a falling rate of change. So if we start to see this move higher, that could point to another inflationary wave that is upon us. But at the same time, look, the Fed, they met last week. They decided to keep rates steady. And Fed Chair Jerome Powell, he made it very clear that the focus right now is on inflation, specifically saying that inflation is further away from our goal than employment, but they had no clue what or if they did know, they didn't let on that they know what the non-farm payrolls report for the month of July was going to look like. So this is the double dose of bad news that I'm talking about. We had inflation moving higher, but then we had the payrolls report. It increased by 73,000 jobs, which and not terrible, but that was below estimates for around 110,000. But it was revisions to the prior 2 months that really stood out. So relative to the initial estimate for May and June, jobs collectively for those 2 months were revised lower by 258,000 jobs. So huge revisions lower for May and June, wiped out most of the gains seen during those months. That puts the 3-month payrolls average at 35,000. That is the weakest growth on a 3-month average since the pandemic. And so, here's what's probably happening. So we saw the uncertainty caused by tariffs at the start of the year, caused by trade war. The trade war that really started to show up in, call it, survey-based data. So things covering consumer sentiment, PMI indicators covering business activities. Those are surveys, and that's where you saw the weakness in data show up first. And so now the concern is, is July's lower than expected payrolls report, and is this huge revision downward to jobs data, is this showing that the hard economic data is catching up to what we've seen with the soft economic data? And so this chart here, it shows for the monthly payrolls report, it shows the initial release. Those are the purple bars on here. This goes back a couple years, but then it also shows where the revised figure comes in. So that's the blue line. And then these bars down here are tracking the difference between those two, where the initial estimate comes in and where the third revision, ultimately where these initial estimates are getting revised to. And you can see, we've had this trend of negative revisions all year, but it's really started to pick up. But one thing you'll notice, and maybe take these revisions with a grain of salt too, is because you've had big revisions featured alongside the payrolls report going back a couple years now. So these negative revisions aren't a big surprise. It is a little concerning to see the magnitude getting larger. It is getting concerning to see the initial estimate really starting to trail off here recently. But I think if anything right now, the labor market really reflects a stalemate. Because of the uncertainty, businesses are growing more reluctant to hire, but the economy remains in decent shape, and so you're not seeing a pickup in things like initial jobless claims that would point to joblessness picking up. And so one thing to keep in mind there is just it looks like we're kind of at a stalemate, holding steady. Even if you want to call it a stalled out jobs market, we're seeing low jobless claims but a lack of hiring. So we're seeing a stalling here in the labor market. With all this data coming out, with the inflation, with payrolls, this is throwing the outlook for rate cuts just absolutely all over the place. So the market's trying to digest all this data. So following the Fed's rate setting meeting last week, when Powell made it clear that the focus was on inflation, and then you had the higher PCE inflation report after that, odds shifted pretty quickly to showing only 1/4 point rate cut this year by the Fed. So coming into that week, markets were expecting around 2 cuts. It's really being debated if September would see a cut or not. Well, after the Fed, after the inflation, that September rate cut mostly went off the table, and odds for total number of cuts this year shrunk to just 1. But then you had that July payrolls report come out, and market implied odds swung sharply the other way. They are now favoring close to 3/4 point rate cuts this year, with the September meeting, that's the next meeting, moving to, I believe, around 80% chance of a cut as well. So back to pricing a cut there. But here's the other thing we're seeing. We're seeing huge shifts in the treasury curve, so in treasury yields. And this specifically looks at the treasury yield, a one-day change in the treasury yield. And I'm bringing this up because 2-year treasury yield tends to lead changes in the Fed funds rate. And before Friday's payrolls data, the 2-year treasury yield had been creeping higher toward the current level of Fed funds. So that was the market's way of starting to price no rate cuts. Well, you then had this huge drop in the 2-year treasury yield on Friday. It was the biggest drop since about a year ago. And so that is another sign that the market is quickly repricing rate cuts after that really weak payrolls report. So just turning to how the stock market reacted. We saw the stocks sell off pretty sharply, especially relative to what we've grown used to over the past couple months. That came after the payrolls data. The S&P 500 ended its streak of more than 60 consecutive days of trading above its 20-day moving average. So again, the market just steadily grinding higher for the last couple months now. But this volatility that we're seeing, this is arriving also right on time based on what you see with the calendar and seasonal trends. So when you look back, July tends to be one of the best months of the year based on, again, this is historic calendar seasonality. So what this chart's taking is it's taking each month and looking at how that month does on average since 1950, for the past 20 years, for the past 10 years. You can see July all in, no matter how you want to slice or dice it, July is a pretty good month for the stock market. But here's where the seasonality headwinds kick in. They kick in over the next couple months, starting with August. So we've got August boxed in right here. This chart coming from Ryan Dietrich over on X. You can see August is pretty flat on, looking back most years, but it's this post-election year which is what we're in right now. August tends to see a big dip. So we're starting to see that challenging seasonality arriving right on cue as August gets started, and it looks like, again, based on seasonal trends, it's set to persist over the next couple months here. So one thing you want to keep an eye on, rising volatility levels could play a big role in the market direction over the near term. So reflecting what you tend to see with the S&P 500 on calendar seasonality, the CBOE's volatility index, this is the VIX, tends to see its median monthly value bottom out in July, and it moves higher over the next couple months. So again, that's not surprising that, that's just basically reflecting the calendar seasonality that we see with the S&P. But here's another reason to track VIX, and that is due to volatility targeting strategies. So vol targeting funds, there's different types of strategies that pursue this. There's CTAs, there's risk parity funds, but they're all kind of doing the same thing. Think of it as operating within a risk budget. They have a risk budget. Equities are pretty risky relative to other asset classes, especially bonds. And so when the risk in stocks picks up, these funds, in order to stay within their risk budget, they have to reduce their equity exposure. So these vol targeting strategies, again, they tend to reduce exposure to the stock market when volatility is rising, when they add exposure when volatility is falling. So we've had this spike in the VIX and decline over this time period. This has been, in my opinion, probably one of the biggest catalysts to pushing the stock market higher, is because you had a rush for the exits as VIX spiked, and now you've had the return since then of this lower volatility environment as VIX has fallen. That's allowed these risk targeting strategies to get back into the stock market. So they've become a source of demand for equities. So since late May, though, this 22 area, which I have shaded right here, this 22 area has held on the VIX on any pullback. So as the stock pulls back and VIX jumps, this 22 levels held the pullbacks. And we're right there once again. So this 22 level, this could really become a trigger level that leads to more, vol targeting strategies to reduce their equity exposure more, which would drive further downside. So keep a close eye on where this VIX is at right here. If we start to jump above this range, that could cause a lot of these vol targeting strategies to rush to get out of the market. While more downside leads to higher vol. That's why you get these big spikes and potential waterfall declines, is because everyone using these strategies is heading for the exits at once. So keep a close eye on that level. Now here's something interesting with how this market has evolved over the past, call it week and a half or so. So the S&P 500, it's only 2.3% off the recent high. So not off the high that much, but the deterioration under the hood has been much sharper and has been happening for some time now. So this blue line on here is the S&P 500. This black line is a percent of stocks across the market that are trading above their 20-day moving average. This recent peak right here was around July 23rd. And I took this chart back a couple years. This is July 23rd. So for well over a week now, we had already seen a pretty sharp pullback starting with the average stock relative to their short-term trend that picked up steam late last week. And so it shows you, though, too, that short-term breadth is already getting near oversold levels. So a reading below 20% historically has marked an oversold condition. So here's that 20% level, and just looking back here, you can see how this tends to mark the low point in terms of a pullback in breadth. This tends to mark an oversold condition in breadth and helps support a low in the market when the market is pulling back. So we still got a little ways to go to get to that 20% level. So watch for maybe some weakness early on this week to get below that 20% level. You could also watch for a positive divergence. That's when the S&P 500 is still making a lower low in price, but this measure makes a higher low. Back here in 2023 is a good example. You can see the S&P 500 from this point to this point making a lower low, but the average stock not as many in short-term downtrends. So that's the positive divergence you can look for on this metric here as well. All right, so the economic calendar is not nearly as heavy this week as it was last week, but you still have, you're still right in the middle of earnings season. So this table on here from Earnings Whispers shows some of the more notable earnings that are due to be released this week. You've got 122 of the S&P 500 reporting, so we're still really right in the thick of earnings season. This is a very important earnings season coming off of the first quarter reporting period, when a lot of companies were faced, kind of initially with the uncertainty around tariffs, and they were either pulling outlooks or not, or giving a large range on outlooks. So it's important to see how companies are guiding the outlook, to see if forward earnings estimates for the S&P can keep moving higher. That's a big factor behind the recovery. So keep an eye on earnings reports this week. Another notable event this week is going to be Fed speakers. So I believe there are 4 Fed speakers lined up, and it is going to be very critical to hear their thoughts on that week payrolls report, especially given the decision to hold rates steady. Now, as the market's been pulling back some, here's how you can use the pullback to your advantage. The way to use it to your advantage is to search for stocks that are showing relative strength. So stocks, make the analogies like holding a beach ball underwater. Find the stocks that are it's difficult to push them down, and they're willing to bounce back to the highs quickly. So that's what makes this setup in ticker UI interesting right here. So you had the initial peak around this 460 level back in February. Stock pulled back as the rest of the market was with the tariff headlines, quick recovery back to that prior high in May, and then making a shallow pullback, testing resistance at that 460 level again in July, and now making a smaller pullback. So again, you want to see this series of smaller pullbacks on here. Mark Minervini calls this a volatility contraction pattern. If you study traditional technical analysis, this looks like an ascending triangle, but either way, it shows smaller pullbacks are indicative of accumulation. You want to see that demand for shares. And so, a couple other things I look for in this UI chart, they've had from a growth profile standpoint, they've had a few really strong quarters of sales and earnings growth. That can help drive momentum in the stock. What I want to see now is this MACD is turning back lower. MACD is just measuring the distance between a long and a short-term moving average. So as you get this reset at the zero line, above the zero line, that shows the shorter-term moving average is moving close to the long-term moving average. So that shows a period of consolidation that's been underway. And then we want to see this breakout from here above this 460 level, ideally the relative strength line. So this is the price relative to the S&P 500. That shows good momentum if we can get that at a new high as well. And on these breakouts, we always want to look for big volume. One way to visualize volume is with this indicator in the bottom panel. It looks at the standard deviation of volume. It looks at what volume's at relative to its average to come up with that standard deviation. Ideally, we see a 2 standard deviation event on a breakout on this UI chart. Well, that is all this week. Thank you for tuning into the market